Ever wondered why some investors seem to accelerate after hitting 1 CR, while others stay stuck for years? We have all heard it: money makes money, or the rich get richer. But what's really happening after the 1 crore milestone? So, today, let's break down why wealth growth suddenly snowballs beyond that point and how you can replicate it through smart investing in mutual funds and equity in India. As you know, in India, a growing middle class and rising financial literacy mean more people are investing through SIPs and mutual funds. Yet, the first few lakhs feel the hardest. It isn't because the rich have secret products. The real drivers are capital scale and the magic of compounding. Most investors spend years chasing the first crore, the first big milestone of financial independence. But once they hit it, something magical happens. The same growth that once took 5 years can now happen in just 2 years or even less. But why does this happen? It's not luck or access to secret investments. It's a combination of three things: scale, time, and compounding. The three most powerful forces beyond real wealth creation. And if you do this right, especially with well chosen mutual funds, could be ethical or any well diversified portfolio, and a disciplined allocation to gold, you can watch your wealth grow exponentially. So the goal of this video is to simplify these concepts, show real data on funds and gold, and help you decide where to invest. If you're looking for help in terms of creating a well diversified portfolio for you, I am already helping 100 plus investors with this. So you can always contact me on the WhatsApp number which you see on the screen. Also, you can find the link in the description. And if you're someone who is looking to dig deep and understand about Sharia based investing, you can find the course details as well in the description. Let's look at the power of scale. So let's say you invest 1 crore at annual return of 10%. At the end of 1 year, your portfolio will become 1.1 CR. That's a gain of 10 lakhs in single year. Now compare that to when you had 10 lakhs. The same 10% but only 1 lakh rupees gained. Same percentage, same effort, but 10x, higher absolute returns. That's the advantage of scale. Once your capital compounds on a larger base, your money works harder and faster than you ever could. And this is where most serious investors start moving from saving to strategizing. They begin to focus on allocation, diversifying across ethical equity funds, gold, and sometimes even global exposure, which are under the Sharia compliance. The magic of compounding. Compounding isn't just about returns, it's about time working for you. Let's take a practical example. You invest 1 lakh per month, that's 12 lakhs a year, in a mix of mutual funds, gold ETFs, expecting an average of 10% annual return. To reach 1 crore, it takes roughly 6 years. But to reach 2 crores, it doesn't take another 6 years. It takes only 3.5 years. Then to 3 crores, it just takes 2.5 years. And that's the compounding snowball effect. Your money is working not only on your capital, but also on the returns your capital has already earned. By the time you cross 5 crores, the momentum is so strong that each extra crore can be added in under 2 years without you increasing even the monthly SIP. Time. The real multiplier. Imagine two investors. Investor A starts at 30, investing 1 lakh monthly in ethical funds. Investor B starts at 40 with the same plan. By age 60, both have invested for 30 and 20 years respectively. Even though B invested for 10 years less, both put in the similar total capital. But A's corpus is nearly double because those early 10 years gave compounding time to do its magic. So earlier you begin, the lesser you're dependent on higher returns. Time alone becomes your biggest advantage. Increase the amount you invest. Increase the amount you invest. This is where most people focus on the wrong thing. They chase an extra 1 to 2% return instead of simply increasing the monthly investment. Let's see the math. If you invest 1 lakh per month for 25 years at 10% return, you will end up with 1.2 CR. But if you increase your SIP by just 10% every year, the corpus jumps to 2.6 crores. So rather than hunting for the next best fund or the best stock to invest, build your earning and investing capacity. And when you already have 1 CR or more working for you, this scaling effect becomes unstoppable. Diversify smartly. Ethical funds plus gold. The funds which we have is Tata Ethical Fund, a consistent large cap performer with 10-year CAGR of around 13%. AUM is about 3,500 crores. Taurus Ethical Fund, which is more concentrated equity portfolio, volatile in short term but historically strong over long horizon. Then you have the new entrant, which is Quantum Ethical Fund, which focuses on sustainability and governance driven companies. Great for adding responsible diversification to your core portfolio. Stability and protection assets. Gold and silver. Hedge against inflation and equity corrections. Over the last decade, gold has compounded between 10 to 12% CAGR, giving balance and stability. Together, this mix ensures both growth and stability, a must once you start managing wealth beyond 1 CR. Putting it all together, let me suggest a sample strategy. For a young Indian investor earning 6 to 8 lakhs per year, here is a practical approach. Start early and automate. Begin a SIP with as little as 1000 rupees per month in any of the equity funds. At a 8 to 12% expected return, your contributions will build to several lakhs in few years. Diversify to other funds. If you can commit more, let's say 2000 to 3000, add other funds as well. Despite higher cost, the sector allocation which you get because of adding new fund will help you deliver double-digit returns. Reserve a small allocations for higher risk options. You can consider putting new money into higher risk funds or direct stocks through small case, only after your core funds are established. Ensure you add gold for stability. Always increase your investments as income grows. As your salary increases or you have a side hustle, prioritize raising your monthly SIP contributions before chasing higher risk products. Remember, doubling your monthly investment has a bigger impact on your future net worth than squeezing out an extra 2% return. What are the mistakes you should avoid? Waiting to accumulate a large lump sum and then invest. Compounding works best over time. Starting with small SIPs now is better than waiting for a 5 lakh bonus. Chasing last year's star performer. The Tata Ethicals Fund recent negative return doesn't mean you should jump ship. That means change a different fund. Just as gold has given 40% return doesn't guarantee similar gains next year. Focus on consistency and long-term strategy. So here is my core idea. Your first crore is the toughest. It's built through discipline, patient and consistent planning of SIPs. After that, wealth accelerates because returns compound on returns. Focus less on timing and more on time in the market. Don't just invest, scale your investing every year. And as your corpus grows, bring in ethical diversification, equity for growth, gold for safety. If you follow this approach for the next 10 years, the same 1 crore portfolio could grow as high as 2.6 to 3 crores with moderate risk and disciplined investing. If you're someone who is planning to build your first crore corpus or grow it to 5 crores or beyond, do message me on the WhatsApp number which you see on the screen. I'll help you design a personalized investment plan and also help you manage these funds. Plus, help you in terms of understanding how you can do a gold allocation. WhatsApp link is in the description below. Start your journey today because every year you delay or every month you delay, compounding delays with you. If you found this breakdown useful, do ensure you subscribe to our channel for more such data-driven investment guides. If you have questions about ethical investments, SIPs, or whether gold fits in your plan, do comment below. I read every comment and try to answer all of your queries. My final disclaimer, this video is for educational purpose only and not financial advice. I hope you enjoyed this video. Thank you for watching and have a good day.